Know China to do better business. Save time and money with expert insights on China trade and investment. Welcome to our channel, Trade with China. Welcome to our channel, Trade with China. Today, we are going to decode the latest economic data released on October 15th by the People's Bank of China. So our goal today really is pretty straightforward. We're taking this complex Q3 financial report, the real engine room data, and boiling it down. We want to pull out the absolute key trends that global traders and investors like you need to get a handle on right now. It's about where the money's flowing, and maybe more importantly, who's providing it. Because things are shifting, aren't they? The whole structure seems to be changing.
Oh, absolutely. It really is. We're trying to move beyond just, glancing at GDP figures. We need to look inside at the financial plumbing, so to speak. And this PBoC data, well, it reveals a pretty decisive shift in how China is financing its growth. It's definitely moving away from that traditional bank-led lending model, and it's moving towards a model that relies much more heavily on bonds and government debt. And that shift, it has some profound implications for foreign businesses, especially as you plan for Q4 and, well, into next year.
Okay, so let's unpack that shift, starting with just the sheer scale of it all. We're talking about the social financing stock, or SFS. Now, for anyone listening who isn't deep into central bank jargon, could you just quickly frame what SFS actually measures?
Sure, yeah. Think of the social financing stock as the broadest possible measure of credit flowing into the real economy. So that's basically every type of funding the financial system provides to non-financial entities. Doesn't matter if it's a traditional bank loan, a corporate bond, government debt. It's the whole picture. It gives you the total financial support that's actually underpinning the economy.
Right, and that support is, well, it's huge. The preliminary Q3 data shows SFS hit 437.08 trillion RMB. And it's still maintaining strong yearly growth, 8.7%. And the total new financing, the increment in the first three quarters, 30.09 trillion RMB. That's, what, 4.42 trillion RMB more than the same time last year?
Yeah, the injection is definitely there, no question. Yeah. But it's the composition of that new money that really needs to grab your attention as an investor. If we sort of isolate that new financing, the increment, RMB loans going to the real economy, they only accounted for about 48.32% of the total.
48%, wow.
Yeah, and that's a really significant drop from the 63.9% share we saw back in Q1. This is really the heart of that structural shift we were talking about.
Okay, so less than half the new funding came through traditional banks. The rest, basically non-bank funding then.
Exactly. And specifically, government and corporate bonds, they now make up a really substantial chunk, 43.3% of that incremental financing.
And that's way up from, what was it, just under 29% in Q1.
That's right. A big jump.
So what is this centralization of funding signal? Is it healthy growth? Or is it more like the government just taking on more of the systemic risk itself?
Well, that's a critical question, isn't it? What it confirms is that financial support is now primarily government-led, fiscally driven. Yeah. See, when bank lending dominates, it's usually commercial incentives driving where the credit goes, right? But when government debt issuance dominates, and remember, that grew by 20.2% in stock, it means policymakers have decided where the capital flows. And that's mostly targeting, large infrastructure projects, public works. So for you, the foreign investor, this means you absolutely have to track fiscal policy. Watch those government spending announcements, because that's now the main driver of credit allocation, not just interest rate changes anymore.
Okay, that makes sense. So given this huge shift towards government bond funding, we need to see if that liquidity injection is actually, translating into real activity on the ground, corporate activity. Which brings us to those classic liquidity indicators, M1 and M2.
Yes, and this is where we start to see the potential payoff, maybe, from all that government stimulus. M1 and M2, they're crucial for gauging activity. M2, that's the broad money supply, includes almost all deposits. Think of it as the total money available, savings included.
And that grew 8.4%.
8.4%, yeah. But M1, the narrow money, that's the really liquid stuff, corporate checking accounts, cash ready to be deployed, kind of like spending money versus savings money.
And the M1 growth, that's the really striking figure here. It grew 7.2%.
7.2%, which is a huge 7.1 percentage point jump from that near zero low we saw earlier in the year. It's quite dramatic.
Wow.
So exactly, the gap between M1 and M2, it's narrowed significantly, down to just manageable 1.2%.
Okay, and why is that narrowing gap so important?
Well, when that gap narrows, it's a strong signal that money is moving. It's shifting out of those longer-term, less liquid deposits, the M2 stuff, and into highly active transactional accounts, the M1 money. It strongly suggests that corporations, maybe households too, are gearing up. They're preparing to increase spending, production, maybe payrolls. It signals real economic activation, not just papering over cracks. It shows confidence, at least in the short-term transactional environment.
And that M1 surge seems to be strongly backed up when you look at the specific lending data, right? Total new RMB loans hit 14.75 trillion RMB in Q3. And we drill down a bit, we can see where that confidence might be coming from. Household medium long-term loans, often mortgages, increased by 1.33 trillion RMB.
Yes, that's steady. But the really eye-popping figure, the one that seems to justify that M1 confidence we just talked about, is from the enterprise sector, businesses. Enterprises increased their medium and long-term loans by a massive 8.29 trillion RMB.
Yeah, 8.29 trillion.
Yeah. That's a very clear indicator of robust underlying investment appetite. Businesses generally only take out that kind of long-term debt when they're initiating major capital expenditure projects. Big investments. It reflects confidence in sustained future demand, long-term growth prospects.
So suppliers watching this, maybe industrial goods, machinery, B2B services, they should really pay attention to that number.
Absolutely. That's a strong signal for them.
Okay, now let's try and connect this domestic picture to the international trade environment. For global partners, the foreign currency data is always key. How is the FX picture looking inside the Chinese banking system right now?
Well, it's interesting. The data sort of presents a bit of a dichotomy. Two different stories happening. On one hand, foreign currency loans actually fell by 5.3% year on year.
Okay, so less borrowing in dollars or other foreign currencies.
Seems like it. Could it indicate decreased demand? Maybe companies are hedging risk, or maybe there's just a preference now for settling things in RMB? Hard to say definitively. But on the other hand, foreign currency deposits surged. They jumped 20%, hitting $1.02 trillion.
$1 trillion?
Yeah.
Just sitting in foreign currency deposits inside China, a 20% surge. Is that a sign of confidence? Like maybe increased trade receipts just being held locally? Or could it be a sign of hesitancy, like international players are keeping US dollars handy, waiting for clearer signals on where to invest?
It's likely a mix of both, honestly, and that's precisely why it's such an important indicator for you to monitor. If it were purely positive, you might expect to see more of that capital being converted and actually deployed into RMB assets or investments. But the sheer volume, over $1 trillion, suggests that foreign entities, or maybe domestic firms with big international trade flows, are holding substantial foreign currency within the system. They're not immediately converting it to RMB or, repatriating it. So it signals stability. In a way, the money hasn't fled, right? But it probably also signals a bit of a wait-and-see attitude regarding actual deployment.
Interesting. What about the alternative, though? The sort of steady march of RMB internationalization. Are traders actually using the local currency more often?
Oh, definitely. That trend is quite steady, and it's undeniable if you look at the numbers. Current account RMB settlement that's mostly trade and goods and services that totaled 13.06 trillion RMB in the first 3 quarters. And direct investment RMB settlement reached 6.04 trillion RMB.
So the willingness to use RMB for trade and investment is clearly growing.
It is, significantly.
And the relevance for global traders here seems pretty clear then. As RMB use grows, and as the financial system diversifies like we discussed, the currency conversion risk naturally goes down for partners willing to settle in RMB. It just makes working directly in the local currency potentially more stable, maybe less friction involved.
Exactly. It simplifies things and reduces one layer of risk for international businesses. Okay, so let's try to pull all these different threads together and make it really actionable. What does this fundamental shift in the financing structure, less bank lending, more bonds, actually mean for you, the international investor or trader watching this?
Well, first, that heavy reliance on bonds confirms what we said. Fiscal stimulus, meaning government spending, is really the dominant economic driver right now. So your investment research, your due diligence, it must now prioritize figuring out where the government is directing that bond money.
Tracking the flows.
Precisely. Track the infrastructure spending, the public works programs, key strategic industries, because those are the sectors pretty much guaranteed to see sustained momentum from this funding.
Okay, that's point one, fiscal focus. What's the second key implication? The second is tied to that activation we saw the M1 pickup. The huge jump in enterprise long-term borrowing. It suggests domestic demand is firming up. But and this is a big but, we have to address that persistent structural issue that, experts are constantly highlighting. China still faces this demand structure imbalance. You've got maybe too much productive capacity and investment, and relatively speaking, too little consumption.
Right. The supply side gets boosted, but the demand side lags.
Exactly. And that imbalance, it prevents truly sustainable, self-driven growth in the long run, just relying on credit and investment stimulus, while maybe necessary short-term, just risks expanding supply even further, potentially widening that gap.
So the policy outlook for Q4 becomes really interesting then.
It does. Monetary policy will likely stay, moderately loose to keep supporting liquidity. But the really crucial change to watch for is the shift in fiscal policy focus.
Okay, so the message coming out of this PBoC data, when you combine it with what scholars are saying, is that the era of purely investment-driven stimulus, just building more bridges, more factories, might be starting to pivot. Policymakers are maybe realizing they need to boost the demand side, improve people's livelihoods, their spending power.
Precisely. I think that's the emerging consensus. And for foreign investors, this potential pivot is probably the single biggest takeaway from all this data. You need to start looking maybe a bit away from suppliers who rely only on heavy investment projects and look more towards sectors that benefit directly from consumer spending and social welfare improvement.
Which sectors specifically?
Well, we'd anticipate potentially increased fiscal support targeting consumption itself, things like healthcare, education, consumer services. So if your business targets the Chinese consumer market, this policy shift, if it materializes strongly, could provide a really significant tailwind for you.
That structural pivot, moving from funding just supply expansion to maybe starting to fund the demand side, that feels like the core insight here.
I agree. And, that brings us right back to that one really fascinating indicator we flagged earlier, that massive surge in foreign currency deposits. Remember, up 20% year on year.
The $1.02 trillion just sitting there.
Exactly. Despite all these positive signals, the M1 growth, the enterprise confidence you've got, over $1 trillion in foreign currency parked inside the Chinese banking system, that amount of capital, it represents a huge reserve of potential deployment, potential investment, potential spending.
So the question is why it's still parked.
That's the $1 million or $1 trillion question, isn't it? Is this capital waiting? Is it waiting for a clear signal that China really is prioritizing consumer growth, making that pivot we discussed? Or are foreign traders simply holding on to their increased export receipts, parking them in what they see as a stable environment for now? The decision about whether to deploy or continue holding that massive reserve of foreign currency, that's probably the single most important factor for you to monitor as we head into Q4. It'll really signal the true level of international confidence, would you say?
Yeah, absolutely. That's the lingering question we'll definitely be keeping a close eye on. Well, that was a tremendous deep dive, really getting into the financial engine room there. We've clearly established that financing is diversifying heavily away from just traditional bank loans and much more into government bond issuance. That makes fiscal policy the absolute key driver to watch. And that rapid narrowing of the M1, M2 gap, coupled with enterprise borrowing, it really suggests that real economic activation is firmly underway. This channel, Trade with China, will bring you practical knowledge to navigate business, investment, culture, economic trends, and communication tips in trades with China. And your comments really encourage us. They help us realize our video value and motivate us to update more useful information. So please press like, subscribe now for actionable insights and win-win solutions. Don't miss the possibility to understand and make money in trades with China.